Hello everyone. As we do at the beginning of each quarter, let's take a look at the main conclusions that can be extracted from our digital top-down methodology. Our methodology consists of evaluating the attractiveness of European equities based on 4 complementary pillars of analysis. The first pillar focuses on the economic momentum in Europe. Our proprietary indicator remains at a historically high level, despite a slight easing in the third quarter, suggesting a virtuous inflection in economic growth over the next 12 months. The consensus of economists anticipates GDP growth of plus 1.3% in 2025 in the Eurozone, versus plus 0.7% in 2024. Furthermore, we expect economic confidence surveys to improve in the near future as a result of lower policy rates. Let's not forget that, unlike in previous cases since the Lehman crisis, the accommodative monetary pivot was initiated for a positive reason, as a result of the battle won against inflation. In this context, a strategic overexposure to equities remains advisable, and the small and mid-cap segment may continue to benefit in relative terms from its procyclical nature, as has been the case over the past year in Europe. The second pillar deals with the ECB's monetary policy. As anticipated, the Fed followed in the ECB's footsteps with a significant 50 basis point cut in September. The significant fall in inflation expectations suggest that this process will continue over the coming months, and at this stage we expect 2 further rate cuts of 25 basis points between now and the end of the year on both sides of the Atlantic. The third pillar of our analysis relates to valuations. The risk premium on the European equity market is close to the average observed since 2000, while the small and mid-cap segment is at a discount of around 10% to historical standards. In this context, the next period of quarterly publications will be particularly scrutinized. Finally, the fourth pillar deals with the behavioral aspect. As we had predicted since our video at the beginning of April, the indices have moved more horizontally, without however calling into question the long-term uptrend, which remains intact. Small and mid-cap indexes, for their part, have accumulated a significant leg, and chartist configurations suggest a return of the latter to the highs of 2021, some 10% higher, as seasonality becomes supportive once again. The stock market rally that began 1 year ago has logically greeted the sweet spot we highlighted at that time. It fundamentally normalized the major stock market indices. After such a surge, the directionally more neutral sequence we've been observing over the past few months seems logical, without in any way challenging the long-term bullish trend. In this context, the small and mid-cap segment, which is lagging far behind, could play a key role in driving performance over the coming months. That's all for today, and we look forward to seeing you at the start of the next quarter for another market review with Shaheen Capital.